Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we're going to tackle that very thorny topic. Is Telstra a buy at these levels, Paul? Well, you're the man in the hot spot. What do you think of the Telstra prospects?
Well, look, before we get into that, answer that question, why don't we just look at what Telstra's had to say at its recent strategy day?
Yep.
Let's start before we go to the new strategy they've unveiled, the actual announcement around their profit downgrade. On the screen in front of you, you can see some information around Telstra's total gross income and EBITDA. On the left-hand column shows you the original forecast of financial year 18. So you can see that Telstra was forecasting EBITDA of between $10.1 and $10.6 billion. That's essentially their core earnings. Back in May, of course, Telstra said that would now come at the bottom end of that range, and the income, the line above it, would come at the mid-range. So we've assumed that, for example, the May forecast was for financial year EBITDA of $10.1 billion. At the strategy day, Telstra said, look, EBITDA for next year is going to be a lot tougher. So they've forecast EBITDA for financial year 19 of between $8.7 and $9.4 billion. That's taking the midpoint of just over $9 billion, Peter. That's about $1 billion down on this year, which was more than the market was anticipating. Two key reasons, obviously just competition in the mobiles market. So they're saying that income from mobiles is actually going to fall by between about 2 and 3%. Things like excess data charges are going to go because people move on to unlimited data plans. So really intense competition in the mobiles market. And also some delayed receipts from the NBN rollout because of some issues around the cable. Some of the one-off income receipts are going to be a bit slower. So, but anyhow, bottom line, that forecast was below the market's expectations for 2019.
Okay, a very important area when it comes to Telstra's dividends. So what do we know?
So what do we know about the dividend? Well, they did reconfirm the financial year 18 dividend. That's the year ends 30th of June 18 at 22 cents. So we're going to see another 11-cent dividend declared in August. But in terms of financial year 19, no confirmation given there. Brokers are now forecasting that dividend is going to be cut because lower EBITDA. And they're now suggesting typically around between 16 and 18 cents for financial year 19. With more risk to come potentially by the time we get to financial year 21.
Okay, so let's go and look at the whole Telstra 2022 4 pillars plan.
Yeah, so look, the main part of the day was obviously to talk about their 4 pillars, their strategy in terms of what Andy Penn and his team are going to do to turn Telstra around. It's got a sort of four key parts. First of all, simplified product offering. So this is quite very radical plans to cut the number of plans and products they offer from something like 1,800 down to just 20 core plans.
Is that 1-800 or 1,800?
That's 1,800 down to just 20. So, and of course, change the experience for customers, eliminate pain points. Customers will now just deal with Telstra digitally over this once this is all rolled out. So that's hard work to do that, but that's a key part of it. A second part, Peter, was to implement a standalone infrastructure business unit. So this is essentially taking all the exchanges, taking the ducts, the pipes, the overseas cables, putting poles and wires in a telecommunications sense into a separate business unit, and for that business unit to service the other business units in Telstra, plus also the NBN. One day, at least it gives Telstra the optionality of perhaps spinning it off or selling it as a separate unit. So that's going to be complete by the end of financial year 2019. Interestingly, it won't include their mobile telephone assets, so not things like Spectrum and some other things. They want to keep that separate within the Telstra proprietary business because they see competitive advantage there. Simplified structure, this has really got the headlines, 8,000 net positions to go. And finally, cost reduction and portfolio optimisation is the 4th pillar.
Okay, so let's just talk about all the outcomes, Paul.
Yeah, so what does that mean? This is just, I suppose, as some of the key summary outcomes. What, if this plan works, what it actually will mean for shareholders, for staff and for customers. I mentioned that the about cutting the number of plans and products from 1,800 to just 20. 8,000 positions to go. They're going to crunch the number of management layers as well, in some cases by between 2 and 4 levels of management to go. 25%.
Quite extraordinary, really, isn't it? 1 in 4 executives to go.
Yeah, 1 in 4 executives to go. In terms of labour costs, they say that'll translate to a 30% reduction in labour costs when it's complete. They've committed to make sure their total costs stay at FY18 levels or reduce each year, so no increase in total cost, in fact potentially declining total cost over the period. They've brought forward their expanded on some of their changes to actually drive business unit productivity savings. They've currently had a target of $1.5 billion. They've upped that target to $2.5 billion. And importantly, perhaps for a customer and a revenue perspective, this is Telstra's words, they're going to lead the market in 5G. So 5G remains at the cornerstone in terms of how Telstra's going to reboost and grow income going forward.
Okay. Let's see what the brokers have had to say after they looked at the 2022 plan.
Yeah, from data from FN Arena, you can see the major brokers, their recommendations and their target prices for Telstra, and a consensus on the bottom in front of you. Probably a couple of key takes, Peter. They're still marginally positive in Telstra, so the brokers still see some value in Telstra overall. But you've got a few extremes there on the bottom side. It's worth noting that Citi has probably been the most bearish on Telstra and the most correct on Telstra of the major brokers. Their target price is now $2.30. But that all said, they do see some upside, but they're not sort of seeing it as screaming upside, I think would be my summation. So there are a couple of sells, there are a couple of buys. But the brokers, I think, see a little bit of upside in Telstra going forward. Okay, Paul, the big question, where we started, is Telstra a buy? Look, I think at current levels, it's sort of in that area where everyone wants to buy it. It's obviously value because it's come off so far. We know that there's a core business. I think that the market is just a little bit out on management at the moment and wants to see some of the execution risk removed. In other words, they want to see Telstra execute what they say they're going to do. Yeah. I think until the market sees that, it's going to be hard for it to re-rate. And in the absence of a re-rating, I just don't quite see a lot of value in Telstra. I can see the argument about why you buy it, why it looks cheap. But, if you're bullish in the market, I just don't know whether you're going to get that sort of performance out of Telstra. So I'm sort of on the sidelines in Telstra. I'm not a seller, but look, I also don't think it's a raging buy just yet. What's your take? Well, I'm actually not holding Telstra, and I think anyone who's putting together a portfolio, I wouldn't recommend any more than 5% exposure to Telstra. But given that 6% yield you talked about, and you throw franking credits in, it probably is a reasonable bet. I think the $2.30 call by Citi is excessive. But you're right. This management has to actually produce the runs. Yeah, it's interesting, and even with a sort of 16 or 17 cent dividend next year, that's still yielding over 6%. Yeah. But my only caveat to that, of course, is that Telstra was paying a 31 cent dividend. It was cut to 22 cents. We're likely to see it cut next year, and there's still risk it could get cut again. So for yield buyers, I think you've got to bear in mind you've got to factor in lower dividends. And there could be a bit of capital loss. A bit of capital loss, and be patient with Telstra if you're seeing it in the real value category. Exactly. So that's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.